How you doing today? Just when you thought you didn't have to see me today, you're stuck with me again. Sorry to tell you. But anyway, if you can remember yesterday, we started our new unit on money and the role of financial institutions. We're beginning with chapter 11. I just want to review a little bit of what we did yesterday. If you remember, we talked about, as you can see on the screen, that saving money makes economic growth possible. One person's savings represents another person's loan. Savings makes investments possible. We put money in the system by saving in one way or another. Maybe it's actually in a savings account, or maybe it's an investment. I went through all these definitions already yesterday, and I really don't want to do this again, but please look through them and notice their importance as we go through some of the other information today. Now, we did get to the point where we said banks are not the only way capital is circulated. Non-bank financial intermediaries do that also, like finance companies. If you remember, we talked about they exist in automobile dealerships, so people will buy cars right there. They don't lose the customer. Life insurance companies also circulate money because they take your life insurance premium and they invest it. Pension funds also are a way that money is circulated because your boss, your employer, will put money into the system for you that they will invest to make money so they can pay you when you retire. This is where we kind of ended up. These four investment considerations were huge, and if you can remember, we took a little bit time on the compound interest spreadsheet, which again you can access on my Canvas page if you'd like to play around with that. But consistent investing can yield large returns, and if you remember, the moral of the story was when you do it early. Now, we did this a little bit in one class, but we didn't really get very far. Other classes, this is the new information for 11.2, which is on the back side of your sheet. You want to fill in as you go. But we're going to go through now different types of financial assets, like a bond. If you want to write next to this word bond, you could write the word contract. It's a contract between the person that's selling and the person that is willing to purchase and give their money up for a certain amount of time. Three main components are the coupon, which means the interest that they will pay you for investing in that bond. The maturity is the time frame that bond will be available. Like corporate bonds and U.S. Treasury bonds can be 5, 10, 15, 20, and 30 years. And then the par value is the principal value of the bond, maybe the face value. Bond prices are determined by supply and demand. So again, if there are more bonds available on the market, the prices for the bonds aren't as expensive, and vice versa. AIR, annual interest rate, divided by the purchase price is how you determine the current yield of the bond at any time you own it. If I wanted to buy a $1,000 Apple bond, let's say, if I only paid $800 for it, I would take, and they offered me 6% interest, I would take that annual interest rate of 6% divided by the purchase price to see how much I would have invested at that point. Now, bonds are pretty common, and there are bond markets to buy and sell, but like I said, corporate bonds and U.S. Treasury bonds are ones we typically think of. On page of your textbook 312, you might want to write down, I believe it's 312, there are bond ratings. At some point you may want to look that up to look at all the different types of ratings for bonds, but bonds are rated by these three items: the financial health of the issuer, the ability to make future coupon and principal payments. Remember, coupon means interest payments, and principal means par value payments, and the issuer's past credit history. In other words, are bonds doing what they're supposed to be doing? That's how they're rated. Bonds range from a D being the lowest, AAA being the highest. That indicates the quality based on, again, the way these are rated up here, these three ways. Standard & Poor's and Moody's, you'll find out on page 312, are the most typical bond rating services that people use. If a bond is in default, it means the issuer has not kept up with interest or coupon payments or par value or principal payments. Like a bond that's BA or BB or lower, depending on the rating service, that's called a junk bond. I alluded to those, I believe, yesterday a little bit, but a junk bond is like in a very high risk environment where they will offer you a higher interest rate if you invest, but the risk is higher. If that bond fails, there's more of a chance you'd lose your money. So junk bonds have made billionaires out of Americans because people are willing to take a higher risk. And an example would be a third world country that has a company that's trying to build infrastructure projects in that country, and if that business does actually get the project finished, you might get paid and you could make a huge return because of the higher interest rates. But also, since it is a third world country, maybe there is a government problem where the project doesn't get finished and the risk you took means you're going to lose money on that. So that being the case, we're going to talk about now different financial assets that people tend to invest in and their characteristics. I am going to get into much greater detail in a little bit when we get to section 3. But to start, CDs are the most common form of investing in the United States. They're easy. You can even do it at your young age, even younger. Most banks offer certificates of deposits. You can obviously go through a broker or financial planner to get these, but it's a very easy way to invest. It's a timed deposit, meaning they will keep your money for a certain amount of time, and if you decide to take it out early, there's a penalty where you basically lose the interest you made. Another form is a corporate bond, which we talked about bonds already, but corporations offer bonds for sale also, maybe in the maturity range of 5, 10, 15, 20, 30 years. They're usually for a long-term investment, but they can be liquidated quickly. You can sell them on bond markets. You don't necessarily have to keep them for the entire length of the maturity. Obviously, if you want to sell them, hopefully the prices are going up, you can still make money on that exchange in price. A third one is a municipal bond. Obviously, you can read state and local governments usually sell these. They're considered a very safe tax-exempt investment. For example, Northwest Allen County built this addition onto Carroll High School that cost $64 million. In order to get the money so they could build the addition a few years back, they had to offer municipal bonds to get the $64 million to be able to build it in a 3-year period. They would have never been able to collect enough tax revenue to be able to get that built in a good period of time. These bonds are sold literally to people all throughout the world, and communities will sell these on different things, like bonds were sold for Parkview Field downtown, adding on to the Coliseum. Maybe there's a bridge construction project that they're selling bonds. I guess they're very safe because people realize the government will eventually have to pay them back by raising taxes to be able to get the money to pay their investors back. And plus it is tax exempt, so you can write it off. Savings bonds, I assume you're familiar with. Some of you probably have those. Low denomination, so that makes them attractive. I think you can get $50 bonds, which actually only cost you $25 when you originally purchased them. But by the time of maturity, they end up being doubled. They would be $25 to $50 bonds after so many years, whatever the range of maturity is. They're very attractive, virtually no risk, even though there's no such thing as a perfect investment, but at least it's a very low risk. Treasury notes and bonds. These are U.S. Treasury notes or bonds that are, keywords here, large long-term obligations. Again, 5, 10, 15, 20, 30-year bonds. And they are, this could be hint, a test question, considered the safest of all financial assets. Now, again, the government does offer these to other countries, to investors in the United States. I may even purchase those. Parents might. The idea is that they're a little bit safer, and you're trying to keep your money from maybe being taxed when you purchase these because you're keeping them for a little longer term. So they are attractive, and we know that we've built up quite a debt printing more of these off, and we owe, as you remember, 35% to other countries, and a lot of that debt comes in the form of these bonds that we have to pay back. Now, Treasury bills, notice a bill is different. It's a large short-term obligation, usually in the range from 3, 6, 9, 12-month obligations. And again, these are safe investments, but they're more short-term. Maybe I had a profit this year in my corporation, and I don't know what I'm going to invest in yet, or if I'm going to grow my business. I may buy Treasury bills and till I decide what I'm going to do with that. They're short-term, like I said, less than a year. IRAs, again, we've discussed a little bit. That thankfully was brought into law in the 1980s through Ronald Reagan, which allow you and I to create our own long-term tax-deferred time deposit intended for retirement. In other words, I can create my own retirement, not relying just on Social Security or just maybe stock investments or what have you. The idea is there's certain rules when you start these type of retirement accounts, but the intention is for you to keep them in there for a longer period of time without being penalized. And there might be things like Roth IRAs, which these are important to remember, kind of a life lesson here. Roth IRAs are IRAs that don't get taxed when you take them out. You put in the money as taxed, but when you take it out, it's not taxed. And if you think about that, that's a huge advantage because, however many years from now, whenever you retire, that Roth IRA will be worth a lot more when you retire. You won't have the government taking bigger chunks of that money as you take it out when you retire. Traditional IRAs are tax exempt when you put them in, but when you take them out, then they're taxed. There's basically 4 markets where money from the financial system circulates. Obviously, this is a test question, hint, hint. There's capital markets where money is loaned for more than a year. For instance, like U.S. savings bonds like we talked about, those type of things. You have money markets where money is loaned out for less than a year. That might be, like a Treasury bill, or there is instances where you can create a money market account where you might write checks off of some of your investments after you retire to help you just do day-to-day stuff. Primary markets are where only the original issuer can repurchase or redeem a financial asset. For instance, IAB, which if you know is a local bank, and they they have publicly held stock, but it's actually only held by people they determine who they want to hold it. So I guess in a sense it's privately held. But anyway, the point is, if whoever owns stock in IAB Bank, they can only sell it back to IAB. They can't go and take it on the public market, like let's say the New York Stock Exchange, and try to sell it. Only sell it back to the original issuer. Then there's secondary markets, where those markets you can take assets and resell them to new owners. Obviously, the most famous secondary market in the world is the New York Stock Exchange. So that being the case, the New York Stock Exchange would be, and there's other exchanges we're going to talk about in a few minutes, where people can buy stock at one point and then go resell it at another point to make a profit. So we're going to continue now in a few minutes with 11.3. Hopefully that gave you a little more information to help you understand more about investing as we move further.